You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Welcome back, everybody, to the Advisor's Option, the program here on the Options Insider Radio Network for all of you busy financial advisors and asset managers out there, as well as all of you out there who are perhaps looking for a new financial advisor or asset manager, and you're wondering what option skill sets, what options knowledge should they bring to the table. Well, we're here to talk to you guys all about that fun stuff. My name is Mark Longo from theoptionsinsider.com, as well as from a little thing we like to call Ye Old Options Insider Radio Network. 13 programs, a baker's dozen on the old network, including many, many archives of this here Advisor's Option program. Where can you find all of that advisory goodness? Well, no shortage of places, including the mothership, the flagship, theoptionsinsider.com. Surf on over there, click on the Insider Radio Network tab, and you're off to the races. You can click on Advisor's Option, go right to the archives, and stream or download them all there till your heart's content, or, of course, any of the other programs on our network. And, of course, you can also find them in all of the major podcast providers. iTunes, Stitcher, Aha Mobile, TuneIn, pretty much you name it, we're there. And if you don't want to go through all that hassle, that's just too much work for you, then just go grab our mobile app, available for iOS, Android, even the Fire OS. No shortage of ways for you guys to get a hold of the show, download it, stream it wherever you are, and then, of course, fire off some great questions. We love to hear from you guys on the old program. And joining me on said program today are my usual compatriots, starting off beaming in from that tropical paradise known as Puerto Rico. He is Randy Swan, the co-founder of Swan Global Investments. Randy, welcome back to the program.
It's great to be here. As I was saying earlier, I'm really glad to be on Eastern Standard Time at this point in the year. Too many trips out to the West Coast has wreaked havoc on my time clock.
I'm sure all of our listeners are weeping for you, sir, as you enjoy the end of winter here in scenic and sunny Puerto Rico. We thought winter was over here in Chicago, and we got about half a foot of snow yesterday. So you're missing out on all that goodness out there in Randy. I don't think too many of our listeners are weeping for you, sir.
Okay.
Mike, I think I offended the weather gods when I deigned to post something about the start of grilling season this weekend on Facebook. And sure enough, no sooner did I do that, no sooner did the steaks hit the grill, then the skies opened up and the snow started pouring down. So I think I offended someone up there. Not sure who. But of course, I am referring to none other than Mr. Mike Cavanaugh from RCM Wealth Advisor / RCM Alternatives, the ever-growing RCM. Mr. Mike, welcome back to the program, sir.
It is great to be back. Kind of like last show, Randy's in the sun down there. We got snow and we don't have mountains. And I was following your social media posts about the start of grilling season. And it was kind of funny. It looked like as soon as you put those steaks on the grill, the clouds rolled in. So I will blame you for ruining our Monday here with the 5 inches of snow.
I may have to accept that blame because clearly I offended someone with my outrageous assertions that winter was behind us. So maybe we'll move on with that before I risk offending someone else and dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, that music means it's time for our Options 101 segment. Like the name implies, this is the portion of the program where we break down some basic options, concepts, ideas, strategies for you, the busy advisor and asset manager out there who maybe doesn't have time to really dive into all this stuff. You want to know where you should be pointed, which directions you should be paying attention to, which topics and ideas are really top of mind for you. And as we were talking about what to discuss on the show today, we kind of kept circling back to one idea that really seems to be paramount to top of mind for a lot of you out there, whether it's from our interactions with you or you guys writing into the show. We hear questions and variations on this theme quite a bit, and so it seems worthy to really spend some time discussing it on the program today. And that is the concept of paying for your protection. A lot of you guys out there listening are long-only equity asset managers, so you're very much interested in protecting the downside of that portfolio. That's your chief risk. That's why you're tuning in to an options program. Of course, a lot of you out there on the retail side also are interested in actively hedging your portfolio risk. But of course, the number one question we get whenever people start investigating that is, wow, these things really cost a lot. These puts are expensive. Everyone's buying them. They're jacking up the prices. What can I do? Are there any ways we can really offset the cost of that protection? And that really, when you break it down to brass tacks, listeners, is really where the rubber meets the road in the option space. Separate the professionals from the layman, if you will, in terms of what a lot of the pros out there that you're going to pay. If you're going to pay a professional financial advisor to handle your options for you and handle your accounts for you, one of the things you're really paying for is for them to use their expertise to not only hedge your portfolio. Anyone can really do that and buy a put. That isn't that hard. The expertise really comes in managing that position and going the extra mile to find ways, risk mitigated ways to offset the cost of that protection. So that's what we're going to talk about a little bit today. We said on earlier programs, earlier episodes, kind of a good rule of thumb you should be looking at when you're looking at some near-term downside protection for your portfolio. So we're talking near out-of-the-money puts, maybe somewhere in the 3 to 6 month range, depending on how far out on that strike chart you're going. You should be willing to pay somewhere in the realm of 1.5% to 2% for that protection. And so that's a significant number. I can see why a lot of people would perhaps balk at that. So again, there are some basic ways you can reduce that. So we'll start with the most basic and we'll kind of go from there. And of course, the most basic way to offset the cost of any straightforward put purchase is, of course, to turn that into a put spread. So instead of just buying your at the money or your near out of the money downside put and just putting all of your eggs in that basket and shelling out quite a bit of money to do that, perhaps that proverbial 1.5% or 2%, you then are going to turn around and sell a little bit farther out of the money put and turn it into instead a vertical put spread. And what that gives you, of course, is essentially a reduction, sometimes dramatic, sometimes not so much, depending on where that put is that you sell on the chain, where that put is. Of course, that's going to translate into reduced outlay for your trade. And that, of course, is attractive. to a lot of people out there because that's their goal. They want to reduce the amount of money that they're actually spending on this protection. Of course, the downside, quite literally, in this case, is that you're also curtailing the amount of protection that you get from that put spread. So it's very important when you choose your strikes, which put you want to buy and which put you want to sell. It's very important that you consider that and say, okay, I'm only concerned about a near-term retracement to this level, so I should buy a put spread that covers that level. I'm not particularly concerned about an epic black swan type event that's going to wipe out 50% of my gains, because if you are concerned about that, maybe put spread isn't the way to go. But it's worthwhile considering those things before you put on a simple put spread to really make those considerations, determine where your concerns are in the underlying, and then you can kind of go from there. Maybe, Mike, we'll start with you because this is we'll go basic to a little bit more advanced. We kind of caution our listeners already about paying for a put versus doing the put spread and looking at the strikes to really consider what levels they're concerned at in the underlying. Any other basic recommendations you could have to our listeners when they're upgrading from a simple put to a basic vertical put spread?
Absolutely. And I think the key thing to point out what you said was in a risk mitigated fashion. So you have to decide how much risk you want to take on, and are you truly paying for protection. So kind of in the scenario we highlighted, if you're 3 to 6 months out purchasing your protection, define your risk. So you can basically say, look, I'm not really too concerned about the market going down 30%. So I'll buy a put spread that, some people call them knockouts, when you're knocked out of protection at a certain point. So selling the front month put against a 6 month long put to make it a calendar, you'll get a little benefit from some extra theta decay in the short term put. The short term put is going to decay at a faster clip than the longer term put, and as long as you're comfortable with the level of risk, it's going to help you offset some of the costs of the protection. A lot of it also comes into play is, are you starting with a position or not? Because you might be looking for a down move, but you don't want to miss the upside. And if you typically buy 200 shares of the stock, maybe you could buy 100 shares of the stock, buy one put, and then sell two puts. And then if you do get a sign, you're long and you've dollar cost averaged your way in. So you can do a ratio back spread, a 1x2, buy one, sell two. That helps with the income. You're only long half as much as you were, but it gives you a way to kind of cost average in. If the market does go down, you can kind of cost average your way in and then decide if you want to keep that strategy going. But there's really no perfect way. What you have to do is establish your sentiments, establish your risk parameters, and then find the position that makes the most sense and play around with it. Every brokerage firm that we have a relationship with, every custodian, they have risk calculators where you can change the scenarios. You should basically look at every scenario from the perspective of delta, theta, and vega. You don't have to concern yourself too much with the gamma, and there is no row your boat. It's gone. Maybe it'll come back at some point, but look at the delta, the theta, the vega, match that up with your parameters and play with something, and then create a rule-based system on what you're going to do, and make sure that rule-based system that you're creating takes into account how much time you have to manage the position and what your actual time horizon is. I know that sounds easier said than done, but you got to start somewhere. And I think that's what I would recommend when you're looking at offsetting the cost of the put protection by selling more puts.
Well said, sir. You invoked the ratio put spread, so I will add those to the conversation as well. Randy, any pointers, any discussion topics you want to add? First off, on just structuring the plain vanilla vertical put spread, and since Mike invoked them afterwards, we can get into a little bit of discussion of the pros and cons of going down that ratio rabbit hole, as tempting and as dangerous as it might be.
Well, I'll just start off by talking about the basic put spreads. I love the concept of a put spread because you're really trying to mitigate some of the costs of the hedging. I like the concept of actually selling a shorter term option and buying a longer term option to protect. That's what we use in our strategy, generally speaking. So I think that's a very cost effective way. But I think I'd also like to point out that The position that you may start off with in this trade, meaning let's say we're going to buy a 6 or 9 month put and maybe sell a 3 to 6 month put that's further out of the money. I think the other way to look at it is that there's nothing making you stay into that initial trade. So we like to actively adjust the trade or actively manage the trade as the market's moving down if you want to maintain the integrity of the original put protection. So I think you can be a little more aggressive or a little more thoughtful in terms of how you manage the strategy, other than just saying, hey, if I buy a put at the money and I sell 10% out of the money put, that I'm stuck with that limited downside protection. I think that there's just literally thousands of different options that you could actually take advantage of in terms of structuring that risk adjusted profile.
I love it. You guys are diving in. You're getting ahead of me with the concepts, but it's good. I think this is all good stuff. I really want to get out there for our listeners. So we're going from basic to hardcore really quick. Let me dial it back for some of our listeners who may be a little bit confused. Of course, you touched on basic vertical put spread, strike selection being key for that. You really need to determine where your levels of comfort are in the underlying and then go from there. Mike alluded to the ratio, so we can add that on next. And really the ratio, I was hesitant to even include that in this rundown because it is a viable strategy, but it's also, like I mentioned, a bit of a dangerous rabbit hole. I've seen people really kind of get a little bit overboard with the ratio, so I was hesitant to invoke it, but it's worth discussing here. Like Mike said, you can do a couple different strategies. You can do an extra one, so you sell 2 puts instead of buying one. The benefits of that are clear. Let's say you buy a $3 put, and then you sell a $1 out of the money put. Now, well, you net paid $2 for that spread. But now if you sell 2 of those puts, well, now you net paid $1. And now people start saying, well, if I sell 3 of them, now my spread is even. You can see how that gets dangerous fairly quick. Of course, the benefit to that is obvious. Your initial outlay is mitigated very dramatically, perhaps depending on how many you sell at the front. And of course, the downside of that, again, pun intended, is that you now have naked short legs to the downside, to the bottom, to that short strike. So if you blow through that short strike, you're going to be acquiring stock on that level or whatever underlying it might be. So you need to be prepared for that mentally. In the case Mike mentioned, the 1/2, which is probably the most common ratio we see, that of course means you're covered on one leg, you're naked short on another, which means you'll acquire more stock at that level. If you do indeed like the stock at that price and you've done your homework and you decide, I wouldn't mind acquiring more of the underlying at this level, so protect me down to here, and then below it, if I want to acquire more, I like that level, I will write an extra one. That's certainly a viable strategy to go. Just make sure you set aside that margin, that capital for it, or your broker will make you do that, at least a portion of it. So there's no free lunch in these trades. Even people think they can just write these ratios and collect money all day. There is margin, there's capital being set aside to protect you on the downside, protect your broker really on that downside. So bear that in mind. There is an opportunity cost to these trades. The more you write, the more of a ratio you do, the more naked shorts you have, the more capital is going to be tied up in that trade. So it's not exactly the free lunch you may think it is, but I wanted to put it in there because ratio put spreads do indeed have a purpose, and particularly the one Mike outlined is fantastic. Randy mentioned the time spreads as well. We're going to get to that in a second, but first we're going to take the next logical step from there. We've talked about from put spreads. Now people say, well, wait a minute, I still want to pay for this. What are some other things I can do? What are some other positions I could combine to offset the cost of that protection? And we've talked about it many times on this show. I've jokingly, really only have jokingly referred to it as the holy grail position for asset managers and financial advisors. That is indeed the collar, and the collar has a number of benefits that are very obvious. First off, it's combining 2 positions that are relatively intuitive, relatively commonplace for a lot of equity and equity-based financial managers who want to have protection, and they also like covered calls for income. Makes sense to combine those 2. Now you have 2 positions you probably would put on anyway, and now you have the covered call going to offset some of the cost of that collar. And there's different ways you can construct them. Some people like to construct zero-cost collars, which usually means you're going to be stuck in the same expiration month, buying a put somewhere down on the strike chain, and then in turn selling a call somewhere up on the strike chain that roughly are equivalent to each other, so you can come out to some sort of zero net outlay. I don't always like to structure collars that way because, as you said on the show before, it's not the ideal way to structure them. You're not really maximizing your decay. You're maximizing your immediate outlay, which is a good thing. But on the flip side, if you were to go a little bit longer term, and we've discussed collar studies that OIC, our partners on the show, have done many times in the past to show that if you structure with a little bit more nuance, you go a little bit farther out with the put, somewhere in that 6-month time frame, and you write nearer term calls against it, 1 month, perhaps weeklies, if you're very active and aggressive, you can do much better over time by taking that approach. It requires a little bit more management, but on the other hand, it really does work out better for you. So the collar has great benefits, but of course, The downside to it is that you're not writing another put in the put wing that has a lot of implied volatility juice to it. You're writing a call on the call wing, and as we talked about on SKU before on this show, the implied volatility levels of calls above the at-the-money strike, that call wing, as we refer to it, is much lower than we see in the puts for a lot of reasons we've described before as well. A lot of the activity on call options comes from selling on covered call side. So that's going to depress the levels of volatility. So unless you're in one of these aberrant names like Apple right before earnings, you're not going to get a lot of juice, a lot of premium for that call. So bear that in mind when you're writing that call, that you're probably not going to offset all of the cost of that put in one trade. It's going to take a couple to really get the ball rolling. Hence, that's why OIC and others have cited in their studies that you really should go a little bit farther out the put, closer with the call, and then do that time and again, and you over time will do pretty well. Mike, any notes to add, any topics you want to mention here about constructing collars and their efficacy for both retail stock traders as well as financial advisors?
I was just digging. I'll add a plug for our friends, our bald-headed friends from the OIC that couldn't make it today, Alan Grigoletto and Eric Cott. They ran a study, and it had to be about 6 years ago now, from University of Massachusetts at Amherst. Edward Zado wrote the article. It's called Collaring the Cube, and it gives highlights of how to basically actively and passively manage a collar strategy on an index, and they use the cues in the article. So it's a great piece. You can get it off the OIC site, but it kind of gives you some guidelines and guideposts as far as what a money manager should look at, and what, if you're going to manage your own money, what you would be looking at. I'm sure Randy's got some great insights to it. I mean, everything I've been kind of hinting at. You have the ability to work with a company like Randy's. I mean, he's got a rule-based system. He's using all of the parameters that, he's a professional money manager. So you can take the time to learn it on your own, or, you can trust in a money manager like Randy.
Great suggestions as always, Mike. And of course, the collar, there are many different ways you can construct it. I mentioned the 6 month, 1 month time frame. I mentioned the zero cost collar. Another way you can do it is the way I like to refer to as the collar with a kicker, aka the Swan-style type of collar. And Randy, I know you're a big proponent of these. You may have done a few of these in your day. In fact, it's an active part of the overlay you guys construct over there. So why don't you walk our listeners through what a collar with a kicker actually is and what benefits that brings to the table versus a standard collar?
Sure. Thanks a lot. Yeah, this is right up our alley at Swan. This is kind of what our strategy is, our main strategy at Swan. So what that really involves is buying an underlying asset, whether it's a stock or indice, hedging it with some put options that gives you the downside protection. And instead of just saying collar, I usually say there's a call and a put, which, as everyone knows, or we've talked about many times on the show, is really more called a strangle, which means selling an out of the money call and put. And what that really allows you to do is to really generate income that I think is well in excess long term of, or at least what we hope to do, is to generate returns from the income components of the strategy that are in excess of the long-term hedging costs of the strategy. But I think also another thing that I like to point out about the strategy that I really like is that it really allows us to maintain the integrity of the put option. So if you're actively managing the call and the put side on the strangle, you're able to make adjustments during those shorter term trades to allow you to have the downside protection and not necessarily look at it as a limited downside protection until your short put goes in the money and starts having a cost to the trade. So I think it really allows you to really mitigate your hedging costs. It provides you some additional income. And, I think a lot of times people always ask the question, why would you ever want to sell a put when you want to use a put to protect yourself? And I always say selling the short-term put options that's where the money is. That's where I think very robust premiums due to the volatility skew able to take advantage of that. So obviously I'm a very big proponent of this type of strategy. And I think, by making adjustments, by rolling out the options to a different strike price and or a different expiration cycle, really gives you a lot of flexibility in being able to manage these trades.
And just to remind our listeners, when you mentioned, maintain the integrity of that put, you mean exactly what you just said. You mean adjusting it or rolling it to another strike when perhaps the underlying movement requires it. So it's a little bit more active on the management side, but on the other hand, the returns are commensurate to that. And since we're talking about managing puts, let's get into the other strategy you just mentioned there, and you mentioned before, Randy, as well, as not just the collar with a kicker, which is the put spread, but working it the way you described it. And you've outlined your strategy before on the program involving much longer term on the protection side, 2-year leaps, 1-year leaps, et cetera, and then going shorter term on the put right side to help finance that. That's another way, listeners, that you could really adjust the collar construction to indeed pay for this type of protection. So Randy's talking about, in this case, not just buying a simple vertical put spread in the same month. You could certainly do that, but he's talking about going, like we talked about with the OIC before, farther out on the put, very far in this case, several years in some cases, and then going nearer term with the other put that you're writing against it. So essentially, in effect, constructing a time put spread, which of course has all the benefits therein. So Randy, why don't you walk us through a little bit why you choose to go that route of the much longer term put versus the shorter term put written against it versus the almost set it and forget it style of just a simple vertical in the same month?
We like buying the longer dated put options for two reasons. One is we think on an average daily basis, the theta, the cost of owning that put option, is lower than buying shorter term put options. And the second reason is we like to be able to do this on a long-term basis because we don't want to go through periods of extreme market volatility, being forced to, quote, re-hedge the portfolio effectively when your house is on fire or when the market is collapsing. And you could go through scenarios in 2008 and 9 and several other time periods over the last 15, 20 years where it really wouldn't be cost effective or very advantageous to try to insure your portfolio. So those are the two main reasons why we try to go long term. Now, there is a downside to that. Obviously, you're spending a lot more money on an upfront basis in terms of what you're actually investing in the longer term put options. But we think over time it's worked out really well for us. We always look at it, quite frankly, as the true cost of a put is measured over an entire investment cycle. So if you go through our experience over the last, almost 18 years of our trading our strategy, we felt that using the long-term put options with the annual adjustments, depending on what the market does, actually allows us to really mitigate the cost on a long-term basis. So we're actually very happy with the quote cost of using the long-dated puts. We'll see after the next bear market where we end up after 3 full market cycles.
And people may be put off by the more active management component of that, but the management really comes on the nearer duration options. I think it's important to point out for you guys. You guys don't really adjust that long-term put very often. You mentioned pretty much once a year. That's your adjustment frequency on the longer end, right?
An exception. When you go through severe market declines, we like to take advantage of and try to harvest the profits from the sale of those puts. We do that by selling the original put option and re-hedging at a lower level. So we'll take an example in 2008 when we started the year out hedging our portfolios about 1450 to 1500 on the S&P. We re-hedged the portfolio by selling those puts, re-hedging it at close to 1,000 on the S&P, and we were able to capture a lot of excess cash out of that transaction, which we used to reinvest in additional shares. So that's part of the process of trying to have some active management involved in this strategy to try to mitigate and actually provide for profit opportunities for our clients.
That's the key there, the active management. If you're not one of those advisors out there, or you're not looking for an advisor who's going to be very active, then perhaps these strategies aren't for you. They require a little bit more action, but at the end of the day, the rewards are pretty obvious. Mike, I know you guys over there at RCM like to employ a variation on this strategy as well. You like to buy some longer term puts, maybe not the 2-year time frame, more and probably the 3 to 6 month time frame for a lot of your advisor clients. And then you write a lot of near term put spreads and other things like that to try to finance that. So walk us through your thought process on this and what you guys do over there at RCM to try to indeed use these kind of put time spreads, or in your case, maybe sometimes put vertical spreads to finance that protection.
Yeah, the key to it is, kind of like I was sharing before, that you have to define what your sentiments are. And then once you have the sentiments defined, then you find the strategy that matches your sentiment. So do you think the market's going higher? If so, how much, and what kind of conviction do you have? Do you think the market's going higher over the next 2 days and you're convinced, you're so bullish? If that's the case, you have to find a strategy that matches that sentiment. I'm not saying that's my sentiment, but you might be bearish over the next year and you want to find a strategy that, a 10% decrease and how to protect yourself. So there's a whole bunch of different ways to look at it. Whether you have a rule-based system that's very fluid, that you're repeating, wash, rinse, repeat every month, that you're kind of following the same guidelines, same rules. There's nothing wrong with that. That tends to lean towards a longer-term strategy. If you're, changing your sentiment frequently, or if the market's volatile and you don't know, you don't want to participate in a dynamic, long-term strategy, and you want it to be more discretionary, where you can change your sentiment and change the position. I still think that the defining your sentiment and matching the strategy to your sentiment is imperative when you're managing your positions.
I would like to agree with Mike's sentiments and discussion and just add something. At Swan, our focus is really much more on being agnostic or market neutral, not trying to predict what's going to happen in the market. And so our strategy is much more based on having long equity exposure at all times, but having a hedge at all times. So that takes away some of the short-term fluctuations where we may say, we may have a bias, or someone else may have a bias in a short-term nature. So that just shows you the different approaches. I always say there's obviously more than one way to skin a cat. It's just your perspective of how you want to operate and run your strategy, I think, ultimately determines on which one of these types of how to manage the puts and manage probably more realistically the cost of managing the hedge.
Well said. There are indeed many ways to skin that proverbial cat, and pretty much we outlined a lot of the best ways you can do that, listeners. But it all starts off, of course, you guys doing your homework, doing your analysis, and determining what your sentiment is on whatever underlying you're holding in your portfolio. Once you have that, then you're off to the races. You can start off with, of course, buying just that put, and if you're comfortable just making that outlay, of course, that is your option. Pun intended. But then, of course, you can go up the chain from there. You can start off with like we outlined, the simple, basic vertical put spread, and that will offset some of the cost of that protection. Then you can get into the little bit farther down the rabbit hole of the ratio spreads, where, of course, you're buying one, selling two, the most common ratio. But you can go farther down the rabbit hole if you're so inclined. Just be careful with the risks inherent with that. Make sure you understand all of the downsides quite literally with that type of strategy. And then, of course, the collar is another way you can do that, a very common strategy, either zero cost or structure it longer term with the put and shorter term with the calls, however you want to construct it. Then you can, of course, upgrade even farther there from the collar to the collar with the kicker, as I like to call it, the Swan-style type collar, where essentially you have a put spread instead of just a put. So now, of course, you're financing that put with a vertical put spread and also a covered call. And then, of course, you can upgrade that yet again, as Randy was just alluding to, by taking that put spread and turning it not just from a simple vertical put spread in the same month, but really going the way we talked about earlier, maximizing your theta, maximizing your decay, going a little bit longer term with the put. Maybe not as far out as Randy if you're not that comfortable, but somewhere in that range, 6 months to a year. And then, of course, financing that with nearer term put spreads or puts and calls, I should say. You can go weekly if you're very active. Of course, you can also go monthly, and maybe that's a little bit more manageable time frame for a lot of our listeners. And if you're willing to do that, if you're willing to understand and go through all the mechanics of doing that, I think the returns will certainly be very appreciative to you and to your clients, because at the end of the day, that's what you're looking for. If you're looking for an advisor, you want someone who's going to go through this effort on your behalf and really bring this expertise to the table to be able to finance that put. Because if you have someone who's just going out there and just buying a put for you every few months and giving up 2% of your profits or of your portfolio every quarter or so, that's a lot for the portfolio to have to make up at the end of the day. If you're giving up 8% a year, most portfolios don't make that. So you want to find ways to mitigate that, and that really is where the expertise comes in. So if you're looking for an advisor, they should have that skill set. And if you're an advisor looking to implement options on behalf of your clients, you should be willing to start learning about some of these strategies. Start basic and go from there, because these are the ways you can really provide a lot of value to your clients at the end of the day and make yourself and your funds and your portfolio stand out from a very crowded financial advisor and asset manager marketplace. All right, that's going to do it for the old Options 101 segment. Somehow I have the feeling we'll be revisiting this concept, though. I'm sure we'll get a lot of listener mail about it because it is such an important concept at the end of the day. Paying for that protection is really where the rubber meets the road for a lot of advisors out there. Speaking of listener mail, it's time for you guys to take center seat on the old program as we dive right on into the old mailbox.
Listener mail. Listeners write in. Mailbox.
All right, everybody, welcome to the old listener mail segment. Like the name implies, this is the portion of the show where you guys get to write in with your questions, your comments, your concerns. We love to read you guys here, read your questions and comments on the show. No shortage of ways for you guys to send those in, including, like I mentioned at the top of the show, surf on over to the mothership, the flagship, optionsinsider.com. I should say theoptionsinsider.com. Get my own URL correct. That'd be nice. And, of course, while you're there, you can leave a comment on the show notes. You can post a question on our website feedback form. A lot of you like to do that. Of course, you can find us via email, questions@theoptionsinsider.com, or on social media, twitter.com/options, facebook.com/The Options Insider, or via Stock Twits. We're Options Insider on Stock Twits. I always forget to plug that one, but I know a lot of you like to use that one as well. We've got a lot of questions here. Let's see how many we can get to in the time allotted. Kicking things off with a question. Love to have the ladies writing in. This comes from Rose Sparza, and she writes, this question is for the Advisors Option Program. I came across this article recently, and she puts a link to an article over there on Value Walk, and she says, I immediately thought of this program. This young manager utilizes options and overlays two topics frequently discussed on the advisor's option. Of course, the story has a negative bent because the manager appears to have run afoul of the law. Does the negative perception and coverage of options-oriented managers drive you crazy, even if some of these guys seem to deserve it? Listeners, we'll put the link in the show notes, but essentially what she's linking to is an article. It's kind of an absurd thing of someone profiling this high school age hedge fund manager. And yes, I said that. So I think if you're getting in bed with a high school age hedge fund manager, you kind of know what you're getting into. And of course, he ran afoul with some regulators and other things that, capital requirements and things like that, as you might imagine from a high school age hedge fund manager. One of the reasons they brought it to our attention, and I think she mentioned it to us, is that they mentioned in the article, almost in a negative capacity, one of the things he's doing. And the reason the negative capacity, because he wasn't licensed for it by the CFTC or the SEC, was using derivatives. They said that was such a nasty thing, and he was constructing overlays using those derivatives. All topics we've actually discussed on this program, and yet we just did so a few minutes ago. So those are topics that are very near and dear to us. But you're right there, Rose. The article does have a bit of a negative tone, but more so I think because this guy kind of made his own bed. It's kind of a ridiculous concept to be a high school age hedge fund manager. I would hope the people who invested in that, probably his mom and dad, I can't imagine anybody else would, but people who invested in that hopefully knew what they were getting into. And does the negative coverage, well, I'll let you guys dive into this as well. I know for me personally, I've been doing this for a while, so you kind of develop, when you dive into the options market, a bit of a thick skin, because this is kind of the way it's going to be perceived going into it. That's one of the reasons we have a program like this. There was a very broad perception about a decade ago amongst a lot of financial advisors and asset managers that options were indeed the way they're kind of portrayed here. Very risk additive products as opposed to risk mitigating. We just spent a half an hour outlining all the ways that options are very risk mitigating with your portfolio. So clearly we're on the other side of the fence on a program like this. But that's why a program like this exists, quite frankly, not just to educate the advisors and their clients about how to use options, but also to bring them over and say, hey, look, these things aren't as scary as you might have first thought. They're not risk additive. They're risk mitigating when used properly. It doesn't sound like this guy was using them properly. And so that's why we're here, to really combat that kind of ignorance. Maybe, Randy, we'll start with you. I don't want to lump you in with this high school guy who's doing overlays, but Rose wants to know on your take on this and kind of the perception in general from the media of options and how they're perceived from a lot of fund managers as still to this day being perhaps a negative addition.
Well, I think I first off by discussing the concept of what you said. You got to develop a thick skin because this stuff always comes up occasionally, but you can't lump everyone in the same group. And obviously, I feel like it's even funny talking about someone in high school. So I'm not going to belabor that point. At Swan, we focus on solving problems for our clients, and that's really managing market risk. So this does not bother me. It doesn't even surprise me. I just kind of look at it and say, there's questionable things that happen in every aspect of the industry, and like I said, we're trying to focus on solving problems for our clients at the lowest possible price. So that's all I can say about it.
Well said, Mike. Anything to add here on our crazy story that she's sending us?
Yeah, I read the article, and it's like Randy said. I think you just have to have thick skin. I don't see, it says based on review, he's likely to be regulated. He's likely to be, targeted by the SEC or whatever it says. It's not that he's doing anything wrong, as much as the bent of the media. So you kind of have to get a thick skin, and not to say that this kid in high school is the next Randy Swan, but Ken Griffin started his hedge fund, the Citadel, when he was a freshman in the dorms at Harvard. So this kid might, he might have a good strategy. The regulators, I'll probably get in trouble for saying something at some point about regulation if the regulators are listening. But if they were doing a great job all the time, Bernie Madoff wouldn't be in prison. He would have never been able to start a fund, a Ponzi scheme that he had. So it always comes down to education. You, as the reader or the investor, educating yourself to what's most important, what you're looking for in a return, in an investment, and who that money manager is. This kid might be a very high integrity kid that has a strategy. There's been recent changes to the regulatory environment as far as how you're able to solicit the public to raise money. There's a Jobs Act was passed in 2012, and this is the first time since 1934 that states have not blue-skied laws that the SEC has passed. So states are now acting on their own. It's legal in Indiana, it's legal in Michigan to raise money from non-accredited investors through a public portal. So he may not be breaking the law at all, as much as the writer of this might have a bent against this kid, and wants to do some damage, whatever it is. But when somebody's reading this, you always have to ask yourself, and it's kind of like an old wives' tale, only believe half of what you see and nothing that you read. And it's kind of not more true than now. You really have to know how to educate yourself on what to look for as an investor, who you're investing in with, the people, the processes that they have, and at the end of the day, the product. And if you look at it that way, I think you're better off than reading an article and basing your opinion on what you're reading about a money manager.
You're right. The landscape is very much shifting for how these things are regulated, not just with Dodd-Frank and all the big systemic regulatory changes we talked about many times on the network, not so much on this program, but also very recently, the Obama administration is very knee-deep in some reforms on Wall Street. Elizabeth Warren, the senator, is out there beating the drum for reforms. They've gone after the brokerage/advisor space very actively recently. The SEC and the Labor Department kind of disputing over who should regulate what, and there's a lot of back and forth, but they're really trying to crack down on those quote-unquote fees that are out there, as well as how people can market those retirement-type funds and other things out there. So it's very much a shifting landscape. You're right, Mike, and something that I'm sure a lot of our listeners are trying to figure out for themselves, even though the regulators don't seem to know really who's regulating what and what they're going to do. It is very much a fluid landscape, and who knows, maybe this kid is the next Ken Griffin. I'm going to guess no, but you never know at the end of the day. Moving on to our next question. This one comes from JacksonHole. I'm guessing he's a fan of scenic Wyoming. He writes, or perhaps she, I shouldn't assume. Am I correct when I say that I can use any option strategy in my IRA account as long as it doesn't require leverage? A great question, very timely question. We are, of course, recording this right around the tax season time of year. So a lot of people are writing in with questions about tax-deferred retirement accounts and how they could use options. Randy, maybe we'll start with you. What do you have to say here for our friend, Mr. Jackson-Hole, who has some questions about how he can use options in his IRA?
Well, I think the simple answer is that you do have a lot of flexibility in terms of using options in your IRA account. Although my experience is kind of hit and miss in terms of what the various custodians will allow you to do. So, examples of doing covered call strategies seems to be able to do in almost any format that I've seen. Although some strategies or some custodians I've worked with won't let you sell a put spread, or I'm sorry, buy a put spread to hedge your portfolio, is what we were talking about in the previous section. So other custodians I've seen will let you do that. So you mentioned something at the very end of your question regarding leverage. I always think that's a very hard question to, quite frankly, answer, because inherently I always look at options as, they are leverage, but it's just a question of how you use them. So to give an example of something like a calendar spread on a product like the S&P 500. I mean, doing one calendar spread in a $100,000 account doesn't seem to me to use leverage, but in fact, one contract on the S&P is several $100,000. So I think that's kind of steering away from be able to answer the question as it relates to leverage. But I do think you have a lot of flexibility as long as you're not writing, basically uncovered options. I think is probably the standard that we'd all probably agree with, is where you get into problems unless they're cash secured puts.
Yeah, it gets a little bit confusing there at the end when he mentions the leverage, because options are inherently levered instruments by default. So anything you're doing with options is going to have a leverage involved. I think he probably meant something along the lines more of margin, something along those lines. At least that's how I'm reading the question. Mr. JacksonHole, you can write in if we're misreading your question. And Randy's right. As long as you really don't have the naked short legs at the end of the day, most of the strategies you can think of that you like to do as an options trader, you can pretty much do in an IRA. Again, you can't go out and blast out a lot of naked short things unless, of course, you have the capital, like in this case, a cash secured put versus just a naked short put. You have to have the capital in your account to buy that stock or buy that underlying if it drops to that strike. But as long as you have that capital in there, you should be okay. I want to bring up again something Randy mentioned. I think it's important and doesn't get discussed enough in this conversation. He mentioned it depends on the custodian you have. And that's a very key point. You guys probably know this more than anybody, Mike and Randy. You guys have worked with a lot of different firms out there. That the functionality, the knowledge of options is going to vary on a firm-by-firm basis. You may onboard at one firm that disagrees with what Randy says, and that these calendar spreads they require too much margin, you can't do them in an IRA. You may go to another firm that's a little bit more option savvy, and they say, no, that's actually a viable strategy. You should be able to do that. So it's worthwhile checking with your firm first and seeing what they allow. And there are some broad-based things. As long as you don't have the naked shorts, you should be all right. That should be for most of the IRA custodians out there. But that said, it is going to vary somewhat on a case-by-case basis. Particularly, you get some of the more nuanced strategies. They're going to allow you to do certain things. They're probably going to have a better understanding of certain things at certain firms versus others. So it's worthwhile if you're going to be doing a lot of more sophisticated type option strategies, are going to try to in your IRA account, to make sure you go to a firm that has a firm grasp of what you're doing, because they'll probably treat you better from allowing you to do it from a margin perspective and everything else that you'll need as an active options trader in your IRA. Mike, I'm sure this is a topic that's near and dear to your heart as well. Anything you want to add on the topic of what you can, what you can't do in an IRA when it comes to options?
I know that the one thing that is strictly prohibited, you can't do it anywhere, doesn't matter what custodian it is selling naked calls. You can't sell naked calls in an IRA or any kind of qualified account because of the infinite risk it poses by being short a call to the upside, that a stock could go to infinity, and if you were short a call that went to infinity, you wouldn't have an infinite supply of money. So that's what I know is strictly prohibited by whether it's the NYSE or the SEC. No brokerage firm allows any naked call selling in an IRA. And then kind of to touch on what Randy said, then it comes down to the firm. In theory, anything else is allowed. Some firms don't allow that put selling, where you're selling the front month put and buying a back month put, like a calendar spread, just from the aspect of if the person falls asleep behind the wheel, they may end up in a position where they end up owning the underlying from the front month puts that may get assigned, and then they may not, offset by exercising the back month puts. So some firms, they don't want to be in the position at all of ever having to have an IRA go upside down, so to speak, from a cash perspective, from getting assigned with one of the people falling asleep behind the wheel. But that comes up to the option sophistication of the person running the desk. So the only thing that's strictly prohibited by written rule is the naked call, and then it's a firm by firm basis.
And if you want more information on what you can and can't do in an IRA from an options perspective, of course, check out some of the archives of this episode of this program, as well as, of course, our options bootcamp program. We just recorded a new one today, actually, talking about this topic at some length, and we also did one back in July of 2013, episode 25, I believe. So many forays into the world of what you can, what you can't do from an IRA perspective. And of course, Mike has a good point. I think that's really where the rubber meets the road with the custodian perspective. When you start getting into the time spreads, how they understand them, how they treat them from a margin perspective, that's where you want a little bit more sophisticated custodian. So if you're going to be doing what Randy was talking about earlier and Mike about, using time spreads to finance some of that protection, you maybe want to go with a little bit more options savvy custodian, because Mike's right, they could reasonably raise a bit of a ruckus about getting assigned and having some issues there. You want a firm that's a little bit more savvy and perhaps can understand some of the nuances involved, and so we'll let you do that. We'll let you finance that protection using those strategies. Got time for a couple more here. Mike, this one actually sounds like it's for you. You, of course, have been the big proponent, you and the guys over at RCM, of that whole Wheel of Fun, aka triple income strategy. We got a listener here, Mark Brant, who has taken you up, sounds like, on the Wheel of Fun challenge. He has gone down the Apple rabbit hole. He writes here, I started my first Wheel of Fun selling the April 125.71. I love these split adjusted strikes. Puts at $2.17. I hope to be put to and then turn around and sell the $2 covered calls with a $1 long put hedge. So he's actually hedging a little bit, which is nice. He goes on to write, this is Twitter, so it's all fragmented. Bear with me, listeners. He writes, the weekly is the Wheel of Fun is looking sweet. Once you crunch the numbers, collecting premium 52 times a year really adds up. And he finishes up by saying, quite the move toward my strike in the last hour is a nice start and a good omen for my Wheel of Fun. So there you go, Mike. You have perhaps converted yet another convert to the Wheel of Fun. What do you have to say to our friend here who's out there slinging some Wheel of Funds, a.k.a. triple income trades in Apple?
Yeah, the same thing I said at the beginning. It's great that he's done the numbers, he's crunched it up. Mike Tusaw always tells the story of probably the worst thing that ever happened to him was he made money on his first trade, and it inflated his trading ego, and then he paid for it over the course of the next 3 months. So keeping the emotion out of the trading strategy is always the key. It's fun it's a great feeling. It's an adrenaline rush when you make money trading, especially on your first trade. But you really have to focus on the parameters and the sentiments and the risk. Just manage the risk. I've always told people that there's 3 fundamental building blocks whether you're investing or trading, and that's risk management, discipline, and adaptation. You should constantly be looking at everything from how much risk you're taking on, and proportionately, are you being rewarded enough for the risk that you're taking on? You should have the discipline to adhere to your strategy, the risk management parameters that you put in, and then you have to be able to adapt. Like I said, it's great to get somebody that's excited, that's bit by the bug, so to speak, but you want to keep that emotion out of the trading process and stay disciplined, and good luck.
That's one of the reasons, actually, I wanted to highlight that too, because I did like what he's doing. He's getting excited, of course, which is both good and bad, but he does mention too that he is putting some cash towards the $1 put, so he is protecting himself. He's not just He's not just blasting out the puts. If he was just doing that, I probably wouldn't highlight it on the show. But he is taking your strategy, adding a protective leg to it. So it's good to see that he's listening to some of our other programs. It sounds like as well, which is a good thing. He's getting the income bug, but he's also doing it in a risk mitigated fashion. So hats off to you there, sir, Mr. Brant. We've got time here for one more. This one comes from George S. He writes, is it true that a lot of the stock movement we see on expiration day comes from the options traders defending their positions? So does that mean options traders tend to move stocks toward specific prices on expiration days? What should I, as an equity advisor and aspiring options trader, do to profit from this? Well, Randy, this is a very commonly held perception out there that particularly on expiration Fridays, that options traders really rule the roost, that we move stocks hither and yon depending on our whim, and we really dictate where the underlying tends to settle out on that expiration Friday. Some truth to that, a little bit of kernel of truth, a lot of myth and misperception. So what do you have to say to our friend here, George S., who thinks, the options traders are really dictating where these stocks are going out on expiration Friday?
Is that what's happening? I think, like you said, there may be a kernel of truth to that, but I don't think by and large anyone that has a position can always move the market. Second of all, if you really learn out a way to take advantage of what you think is happening, then let me know, because I haven't figured that out yet. So I would just say I'm absolutely willing to listen to a strategy that maybe will take advantage of that, but I don't know how to do that at this point.
Yeah, I think that goes for all of us. Mike, anything you want to add here for our friend George S., who perhaps is buying into a little bit of the tinfoil hat theory when it comes to options and expiration Friday?
Yeah, no, the old tinfoil hat theory. You know what I always tell people as a former market maker, you shouldn't be concerned about what the market makers are doing. And, there might have been 2 or 3 times I saw somebody that had enough of the chutzpah, so to speak, to move a market to a strike or to keep a market off of a strike. But, the billions of dollars behind that and a one time in 10 years kind of occurrence, it may be an issue, it may not be an issue. But what people should pay more attention to, what they're trying to accomplish in the marketplace. Don't worry about what others are doing. Worry about what you're doing and base the decisions on market movements and how it affects you, not the tinfoil hat. Hey, the market makers are pushing this market. Oh, I would have made money, but the market makers have this thing rigged. It's just not worth the time. It's not worth the energy to even think about what goes on. You should know what you're trying to accomplish with each position that you put on, and then adhere to your strategy and not worry about market makers pushing or firms or whatever pushing markets to strike prices.
Yeah, Mike and Randy are right. That is very much in the tinfoil hat theory. There are some underlying fundamental mechanics of how options work when you get into gamma, and particularly on expiration Friday, as that gamma starts to explode and people hedging that gamma. That may, in the aggregate, as everyone's hedging, if in this scenario everyone was indeed had the same gamma position on, and everyone was selling above the strike and buying below the strike, it would tend to keep the underlying closer to a strike than maybe it would otherwise. And that's the one scenario this kind of thing maybe has some merit, but the notion that options traders are just moving things to strikes willy-nilly, depending on their position, that's not how it works. So there really is, there's an underlying little kernel of truth, but it's way overblown compared to the effect that we see of other things in the marketplace on expiration Friday. Good question, George. Don't wear that tinfoil hat too much. It doesn't suit you, sir. All right. A great question. That's all the time we have for the listener mail today. It's also all the time we have for this episode of The Advisor's Option. But before we go, as always, let me check in with each of my cohorts here on the old Advisor's Option panel, see what they have coming down the pike that may interest you. We will start with you, Mr. Randy Swan. A lot of things cooking over there in the land of Swan Global Investments. What in particular do you think will capture our listeners until the next time we can all gather here together on the Advisor's Option program?
Well, I think the only announcement I have this month is Swan is very close to doing a joint venture with another firm to launch a CIT. I think it's investment trust that theoretically allows lower cost investments, and we're in the process of designing different portfolios. I think we're working on 5 different portfolios that use options in each one of those portfolios. So we're going to use a lot of the techniques and concepts we've talked about on the show today. So we're pretty excited about that going into this area of the market that is probably pretty fertile ground.
Yeah, this is a good time for you guys because things are getting maybe a little bit top heavy. People are getting a little bit concerned about some downside in the near future. That's when a fund like yours, an overlay like yours, really seems to get some interest and tends to perhaps outperform as well when these downside moves perhaps start to materialize out there in the marketplace. If you like what Randy was talking about at the top of the show and all the different strategies we were talking about, ways to protect and, of course, pay for that protection, surf on over to swanglobalinvestments.com. You can see all of the details and all the research on the overlay and everything else they do over there. And then, of course, you can reach out to them for some more information. And last but certainly not least, Mr. Kavanaugh, I talked to some of your counterparts over there, I should say, at RCM recently. A lot of things cooking over there. You guys are acquiring firms and changing names. So give us a brief rundown of everything that's cooking over there at RCM.
Yeah, there's a lot cooking. We've got I don't know if you can hear the background noise. I'm on the trade desk right now, but we've got a full house over here. So we've acquired a firm. The RCM Alternatives acquired a firm called Attain, and we're working with them and meeting new people there. They have branch offices in Las Vegas, in Tennessee, in Ohio. So just a lot of energy and excitement surrounding that merger. And then we've got a big event coming up here in Chicago in May. It's going to be at the Mercantile Exchange. It's the first week in May. I believe it's May 5th. if you go to rcmfutures.com and go to the Chicago event, you can register now. There's no cost to the event. In the format, we get some money managers, CTAs that have alternative strategies. We basically interview them, and then we're gonna put some different types of hors d'oeuvres, appetizers, cocktails together. But it's in our hometown. We've been doing these seminars across the country. We just got back from Minneapolis. We were in Phoenix in February, but we're looking to really blow the roof off of this event. It's at the Mercantile Exchange that first week in May, and it should be a good time. All are welcome.
Yes,
all are welcome.
Check it out there in May if you're going to be in Chicago in that time frame. And of course, they couldn't make it on the show today, but of course, surf on over to our friends at the OIC, optionseducation.org. Click on the Options for Advisors tab there if you want to learn more about all the great studies they have and all the analysis, and maybe try to get Eric and Alan to visit your firm and do some options education. They love to do that as well. And on behalf of Randy and Mike, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and for sending in such great questions. Keep those coming, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.